The streaming landscape, once seen as an infinite growth engine, is entering a phase of intense scrutiny.
Billions have been poured into content, yet profitability remains elusive for many.
Today, we investigate the financial health of the industry's biggest players: Netflix, Disney+, Max, Peacock, Paramount+, Apple TV+, and Prime Video. Our objective is to determine which of these giants faces the greatest long-term risk of collapse, consolidation, or significant restructuring within the next decade.
We will dissect their performance across key metrics, letting the numbers guide our conclusions. To assess long-term viability, our investigation will focus on several critical financial and operational indicators.
We begin with subscriber growth, a primary measure of audience reach and engagement.
This is coupled with profitability. Can a service generate more revenue than it spends? Corporate debt, often overlooked, reveals the parent company's financial leverage and flexibility.
Content spending underscores the investment required to compete, while competitive advantages highlight unique differentiators. Through these lenses, we aim to uncover the true vulnerabilities in the streaming ecosystem.
Netflix, the original streaming pure play, demonstrated a significant resurgence at the close of 2023.
According to its Q4 2023 earnings report, the company added an impressive 13.1 million subscribers globally in that quarter alone. This brought its total subscriber base to a robust 269.6 million worldwide by the end of 2023, solidifying its position as a global leader. This growth suggests that Netflix's strategies, including its ad-supported tiers and password-sharing crackdown, are effectively expanding its user base amidst intense competition.
Beyond subscriber growth, Netflix has proven its ability to translate scale into significant financial returns.
The company reported Q4 2023 revenue of $8.8 billion, yielding a net income of $938 million for the quarter. For the full year 2023, Netflix's revenue reached $33.7 billion, with a substantial net income of $5.4 billion. While carrying $14.5 billion in long-term debt as of Q4 2023, this figure is manageable relative to its profitability. This performance suggests a stable, financially sound pure-play streaming entity, a stark contrast to many of its competitors.
Disney+, once seen as Netflix's primary challenger, has encountered significant headwinds in subscriber growth.
According to the Walt Disney Company's Q4 2023 earnings report, the Disney Plus core service, excluding Disney Plus Hotstar, lost 1.3 million subscribers in that quarter. This decline brought its total to 111.3 million subscribers by the end of 2023. While Disney aims for DTC profitability, these subscriber losses highlight the difficulty in sustaining growth in a saturated market, despite the strength of its underlying intellectual property. The Walt Disney Company's direct-to-consumer, or DTC, segment, which encompasses Disney+, Hulu, and ESPN+, reported a loss of $387 million in Q4 2023. This figure, though substantial, represents a significant improvement from previous quarters, reflecting Disney's aggressive cost-cutting measures. Disney's management projects the DTC segment to achieve profitability by the end of fiscal year 2024. However, the company carries a substantial corporate debt of $47.3 billion as of Q4 2023, and its total content spending across all segments reached an astounding $27 billion in 2023.
This illustrates the immense financial pressure to turn a profit.
Warner Bros. Discovery's streaming service, Max, alongside Discovery Plus, demonstrated a period of stabilization and modest growth. The company reported total DTC subscribers across both platforms reached 96.1 million in Q4 2023, with an addition of 1.8 million subscribers in that quarter. Crucially, the DTC segment also reported a profit of $103 million in Q4 2023, a positive sign after the tumultuous merger. This suggests that the cost efficiencies and content strategy post-merger are beginning to bear fruit, albeit within the broader context of the parent company's significant financial challenges. Despite Max's burgeoning profitability, Warner Bros. Discovery as a whole faces a substantial financial burden. As of Q4 2023, the company's corporate debt stood at a staggering $43.5 billion.
This immense debt load, a remnant of the Discovery-Warner Media merger, casts a long shadow over its streaming ambitions.
Furthermore, the company's total content spending across all its segments reached $25.5 billion in 2023. Managing this debt while continuing to invest heavily in content presents a significant balancing act, making WBD one of the most leveraged media companies in the streaming race.
Comcast's Peacock streaming service is steadily growing its subscriber base but at a considerable cost. The platform reached 31 million subscribers in Q4 2023, adding 3 million during the quarter.
However, this growth came with a significant financial hit, reporting a loss of $825 million in Q4 2023. For the full year 2023, Peacock's losses accumulated to $2.8 billion. While Comcast projects Peacock's peak loss occurred in 2023 and aims for break-even by 2025, the scale of these losses indicates a challenging, cash-intensive ramp-up.
The question remains if this investment will ultimately pay off.
Paramount Plus, including Showtime DTC, added 4.1 million subscribers in Q4 2023, bringing its total to 67.5 million. This growth is respectable, but its direct-to-consumer segment still reported a loss of $490 million in Q4 2023. Paramount Global, the parent company, shoulders $15.5 billion in corporate debt as of Q4 2023, while spending $11.8 billion on content across its entire portfolio in 2023. The combined pressure of ongoing streaming losses and significant debt for a company of its size indicates a precarious position, requiring substantial improvements in DTC profitability to ensure long-term stability.
Apple TV Plus operates on a fundamentally different business model than its pure-play competitors.
It is not designed as a standalone profit center but rather as a key component of Apple's broader services segment, which generated a colossal $23.1 billion in revenue in Q4 2023 and is highly profitable overall. Apple TV Plus's estimated content spending of $1 billion to $2 billion annually is relatively modest compared to rivals, yet it produces acclaimed, high-quality programming. Its primary competitive advantage lies in bundling with the Apple ecosystem, driving hardware sales and customer loyalty rather than direct streaming profits. Similarly, Prime Video's strategy is intertwined with Amazon's massive e-commerce and Prime membership business. It serves as a significant value add for Amazon Prime subscribers, enhancing loyalty and driving retention for the broader Prime ecosystem rather than standing alone as a profit driver. Amazon's overall North America revenue for Q4 2023 was $105.5 billion, with international revenue at $40.2 billion and AWS contributing $24.2 billion, demonstrating immense profitability across the company. While Prime Video and Amazon MGM Studios spent $7 billion on content in 2023, this investment is absorbed by a highly profitable parent, making its direct streaming profitability less critical.
Hulu, a veteran in the streaming space, now operates entirely under Disney's wing. With 49.6 million subscribers as of Q4 2023, Hulu offers a robust library of current season network TV and live programming. Its future is now fully integrated into Disney's long-term streaming strategy, following Disney's acquisition of the remaining 33% stake from Comcast for $8.6 billion in Q4 2023. While Hulu's individual profitability is folded into Disney's broader DTC segment losses, its content and subscriber base are critical assets for Disney's bundled offerings and projected profitability by fiscal year 2024. Content spending is the lifeblood of streaming, yet it's also a primary drain on resources.
In 2023, Disney's total content spend reached $27 billion across all its segments, outstripping competitors. Warner Bros. Discovery spent $25.5 billion, and Netflix invested $17 billion.
Paramount Global allocated $11.8 billion.
In contrast, Amazon's Prime Video and MGM Studios spent $7 billion, and Apple TV Plus an estimated $1 billion to $2 billion. The sheer scale of these investments raises questions of sustainability, particularly for companies facing significant debt and ongoing streaming losses.
Who can maintain this pace?
Corporate debt levels represent a crucial vulnerability, particularly for media conglomerates pivoting to streaming. Comcast, the parent of Peacock, carries the highest corporate debt at $96.8 billion as of Q4 2023. Disney follows with $47.3 billion, and Warner Bros. Discovery with $43.5 billion. Paramount Global's debt stands at $15.5 billion, while Netflix's long-term debt is $14.5 billion. For companies like Comcast, Disney, and WBD, these immense debt loads limit financial flexibility, making sustained streaming losses more perilous and potential investments more difficult to secure. This debt acts as a drag on future growth and stability. A clear profitability divide emerges among the streaming players. Netflix, the pure-play veteran, generated $5.4 billion in net income in 2023, showcasing a robust business model. Max's DTC segment reported a $103 million profit in Q4 2023, a positive sign for WBD. However, Disney's DTC segment still lost $387 million in Q4 2023, though it projects profitability by FY24. Paramount Plus's DTC segment lost $490 million, and Peacock recorded a staggering $2.8 billion loss for the full year 2023. This stark contrast highlights the financial strain on traditional media companies struggling to adapt to the streaming economy. Competitive advantages are crucial for long-term survival. Netflix benefits from its global scale and pure-play focus, allowing agility. Disney Plus leverages unparalleled, globally recognized intellectual property. Max boasts the deep library of Warner Bros. And HBO. Apple TV Plus and Prime Video have the immense financial backing and ecosystem integration of their tech giants. Peacock and Paramount Plus, however, face a tougher battle. Their content libraries, while valuable, may not offer enough distinctiveness to stand out against larger, better-funded, or more established competitors, making them more vulnerable in the long run. Given the intense competition, massive content costs, and varying financial health, consolidation or outright shutdown remains a tangible threat. Services consistently racking up billions in annual losses, lacking a clear path to profitability, or burdened by significant corporate debt, are most at risk. Parent companies, like Comcast or Paramount Global, may eventually decide to cut their losses if streaming ventures continue to underperform. The industry trend suggests a move towards fewer, stronger players, potentially through mergers or acquisitions, rather than an endless expansion of services, making smaller, struggling platforms prime targets. When evaluating which streaming giant faces the greatest long-term risk, the evidence points most strongly towards Peacock and Paramount Plus. Both services are operating at significant losses. Peacock's $2.8 billion annual loss in 2023 and Paramount Plus's $490 million Q4 2023 DTC loss are substantial. While Comcast has a vast corporate debt of $96.8 billion, making Peacock's losses a greater drain, Paramount Global's smaller scale, $15.5 billion debt, and total content spend, $11.8 billion, mean its $490 million DTC loss for Paramount Plus represents a larger proportion of its financial capacity. Without clearer paths to sustainable profitability and stronger competitive differentiation, these platforms are most exposed. The streaming market is overdue for a significant correction. While Netflix has found its stride and the tech giants leverage streaming as an ecosystem perk, traditional media companies face an undeniable reckoning. The immense debt burdens, coupled with billions in ongoing streaming losses and unsustainable content spending, highlight a precarious future for several players. Our analysis indicates that Peacock and Paramount Plus currently exhibit the highest degree of long-term risk. Their financial models, reliant on continuous heavy investment without clear, imminent profitability, make them prime candidates for consolidation, strategic downscaling, or even eventual shutdown in the coming decade. The era of unlimited streaming growth is over.